Hey, good morning and welcome to this Wednesday, July 19th edition of Trading Places Live. I'm Tom Bowley, Chief Market Strategist at earningsbeats.com, and I'll be your host for the next 30 minutes as we prepare for the trading day ahead. A couple of quick announcements to get started. This week, we've had our Trading Places Live show Monday, Tuesday, Wednesday. There is going to be no show tomorrow. I'll actually be traveling out of town. So just those 3 days this week. We do have a live trading show or live trading room that will begin at 10 a.m. this morning. That is a members only trading room. But if you are interested, we have a free 30-day trial. Make sure you go over to earningsbeats.com and check that out. If you're tuning in to our show for the first time today, or you're more of a recent listener, watcher, whatever, make sure, well, first of all, welcome. We certainly appreciate you tuning in, but make sure you like our video below, and then also please subscribe to our channel. We do events from time to time. If you're subscribed and you turn your notifications on and we have a live event, you'll immediately be notified. So please make sure you have those settings correct. Starting next week, we're going to go to our regular schedule, which is going to be Trading Places Live shows at 9 a.m. Eastern Time, Tuesday, Wednesday, and Thursday. So no shows on Monday and Friday. Obviously, well, it gives me a lot more flexibility to do some of the things I need to do here at Earnings Beats, also traveling considerations, that sort of thing. So Tuesday, Wednesday, Thursday, but we will have our live trading room for our members every Wednesday at 10 a.m. So right after the show ends, normally the show is going to end around 9:30 or a little bit after, we will jump into that trading room at 10 o'clock. I can tell you this morning, I'm going to focus a little bit on earnings. We are starting to move into earnings season. I want to talk a little bit about how we handle that at Earnings Beats. And if you like to trade the volatility with earnings, I'll give you some ideas of some of the things I like to look for. So anyway, all of that coming up. I just want to make sure that you are aware. Let's go ahead and get started. So I will share my screen for you. All right. So yesterday, another strong day for the market. Dow Jones Industrial Average up a little bit more than 1%. S&P 500 up 0.7%. The NASDAQ 100 up about 0.8%. Mid caps 0.9%. Small caps, the big winner, up 1.4% yesterday. So small caps coming back to life. A lot of that had to do with key areas like financials, which we'll talk about in a minute. But transportation stocks also jumping. A lot of times small caps and transports tend to go along for the ride together. And that's exactly what we're seeing here over the course of the last several weeks. As transports bounce back, we had 3 or 4 days where we took a little time off, little profit taking. Well, that's in the rearview mirror. Big day on transports yesterday, rising more than 2%. I can't even begin to tell you how bullish I am when we start to see transports jumping like this. That is a really good signal about our economic strength, or about the upcoming economic strength. That's the reason why transports go up, either because more goods are being shipped or we're anticipating more goods being shipped. No other reason for transports to go up. So, and when transports are in a move like we're in right now to the upside, this normally launches, and I'm talking about historically, this normally launches the S&P 500. So all the bullishness I've talked about, a lot of folks looking at the charts couldn't see it, didn't understand it. Well, now we're starting to see it evolve into many of the charts and their prices. Financials, it's good to see financials going. We now have a nice uptrend building in the financial group, and this has been one of the laggards. This is what bull markets are made of, rotation. When we see one group, start to pull back for a little bit, instead of money moving out of the market, it actually just rotates. It rotates into other areas. So everything goes along for the ride to the upside. Obviously, some more than others, but we want every area to participate to some degree. Financial starting to do that. Technology continues to just be the leader. This is what you expect from secular bull markets. Another 1.13% yesterday on technology. Real estate up down to 0.8%. That was your laggard, along with utilities. Most of the defensive groups did not do well yesterday or do as well. Looking at industry groups, investment services, this is a group that's been struggling for a while, but check out this breakout. This looks like a little bit of a bottoming. I mean, you can call it a sideways consolidation. You can call it a bottoming head and shoulder. It looks like that low may not have taken out that prior low. So technically not a head and shoulder, but it's kind of that similar pattern. We go down, we come back up here, go back down, come back up, equal highs. And the reason the equal highs, this is kind of an early sign across, many of the areas of the market. But normally in a downtrend, you have lower lows and lower highs. And so when you put in a lower low and lower high, lower low, lower high, lower low, when you actually end up going back in and putting in an equal high instead of a lower high, it at least should start to get you thinking that, hey, this could be a bottoming pattern beginning to set up. And so that's exactly what happened here with investment services. Moved back up. We had a double top. We pulled back. We held the lows. And then look at what has happened here. A couple of days ago, we had a slight breakout, pull back. We held the 20-day moving average and then exploded yesterday to the upside. We've had a lot of these different areas that have run. Some areas, like in the financials, we really haven't seen that yet. I believe it's just beginning. So areas maybe where you would want to, underweight because of their lack of performance are now starting to suggest you might want to go back to equal weighting them, maybe even overweighting them. I mean, that's the way. Look at transports. Transports would be a great place to be overweighted right now, but that wasn't the case for much of 2023. So we need to pay attention to this rotation. It's bullish. I dare anyone to talk about this as being bearish. I mean, I don't understand how anyone could still be looking at this market bearishly, but these breakouts in this rotation, in my opinion, extremely, extremely bullish for the market. And I'm talking about for the long term, for down the road. I'm not talking about what happens this week or next week. I'm talking about down the road. This is really good action for the market. Banks also, you can see that double top on the attempted rallies here over the last few months, right around the 425 level. That's in our rearview mirror. Now, I'm going to show you another chart of the banks in a little bit. And, they don't look great, but I do believe their bottom is in. I don't know if they're just going to go screaming at this point. They got some more overhead resistance that we'll talk about. But for now, they are certainly starting to show signs of an uptrend in play. Software, big day yesterday. Right in the middle of the day, Microsoft announced its $30 per month subscription to its AI service. Microsoft absolutely exploded. I think their market cap jumped by about $140 billion in an hour. I mean, that's mind-boggling to me. But you could just see it on the chart. And in fact, I'll show you that in 1 second. We did break out on software. One warning sign that I'll give you here, and this is, we're seeing this a lot in many areas of the market. We're breaking out this time with a much lower PPO. So what I say to that, when you get that breakout, seeing the negative divergence right now doesn't mean we're going to start going down right now. What I wait for when we get breakout like this with a negative divergence is a reversing candle. So a big gap up followed by selling all day, bearish engulfing candle, dark cloud cover. Maybe you gap up and just shoot higher intraday, and then you come back late in the afternoon and print maybe a shooting star, which looks like an inverted hammer. Those types of candles with a negative divergence can be extremely powerful short-term signals. And I talked last night at our Max Pain event, and we went over a number of signals that we need to be careful about. Options expiring this week, the time of the year. We're going into a much more cautious or even bearish time period throughout the year. Later today, I actually did a recording for Your Daily 5. So if you go onto YouTube, probably later this morning or early this afternoon, and just Google my name, Tom Bowley, Your Daily 5. But that should be published, or it should be on YouTube later today. And I went over 5 warning signs for the short term. So you might want to check that video out later today. But let's take a look at that Microsoft chart before we move on. So I want to show you intraday what happened yesterday. I was watching all of a sudden, the NASDAQ was lagging. S&P 500, actually, before I even go there, let's take a look at the QQQ. So I was looking at the QQQ, and then all of a sudden, right here before noon, I saw this big move up. We were down. The QQQ was lagging. Money was rotating away from the QQQ. And then all of a sudden, this big pop in the middle of the day where he moved to new highs hit. And I started looking around to try to find, I was going through all the big names, the Apples and the Microsofts and the NVIDIAs and the Teslas and the Amazons and Googles and so forth, to try and find, okay, what happened? Well, what happened was Microsoft. And look at Microsoft at 11:30 just explode to the upside. I mean, we're talking about $344 to $367, $23 move, which is about 7%. We're talking about, more than a $2.7 trillion company, something like that. A 7% move in a company that size is massive. And so, yeah, I mean, maybe it's probably more than the 140 billion. Maybe, during this hour, maybe it was 170 billion. But whatever it was a lot. And so I immediately started searching to find out what happened. And of course, Microsoft came out with that announcement, and the stock went up. Everybody jumped on board, and then you can see they were selling into the close. But still, it was a big announcement. The market right now is still in this AI craze, and I wouldn't be surprised to see Microsoft go higher in time. I don't think that's the end of it. But yesterday, it was a pretty big move, and that's what triggered the NASDAQ and triggered many of those technology names, software names, in the afternoon, late morning and early afternoon. All right, 10-year Treasury yield. So first, I want to mention there was an economic report out this morning. The housing starts and building permits in for the month of June, and they were both disappointing. The June housing starts expected to come in at 1,480,000 units, and instead we saw 1,434,000 units. So pretty big miss. June building permits expected to come in at 1,483,000 units, instead came in at 1,440,000 units. So both came in roughly, 3% or so below expectations. But I looked at the home building ETF in pre-market, and it was flat. So again, it's almost like, when the numbers come in a little bit weak, that takes some of the pressure off of the Fed to hike rates. It also takes pressure off of potential inflation. And so the longer end of the yield curve starts to move down, or can continue to move down. So we're in this mindset now where if you see a great number on housing starts and building permits, you think, oh, economy strengthening. That's great. That's good for stocks. And then if it's weak, you start thinking, well, all right, well, that's going to help with inflation. And it's going to make the Fed's job a little bit easier. And so it's good from that perspective. It's almost like we're in any news is good news kind of environment. And that's generally what you get when you get a low VIX environment, volatility index, and a bull market move to the upside where we just continue to trend higher. The market gets boring, and it just continues to move to the upside with little volatility, very little selling. What happened to all those big gap downs that we saw in 2022 and even into early 2023? They're gone. I mean, we still have bad news out there. So why no more gap downs? Well, I can tell you why. Manipulation is over, folks. Wall Street's got their shares. They were loading up while everybody was panicking out last year. We talked about it throughout the entire second half of 2022. Kept seeing all those big gap downs, early morning weakness. So you're getting the manipulation to the downside at the open by the market makers. And then you had the retail traders panicking, selling in the morning. And then we saw buying all day long, rest of the day. That was the pattern for several months of 2022. And I said, Wall Street's accumulating. Wall Street's accumulating. We're going to go higher once they get their shares. Look at what's happening. Now, all of a sudden, where are the gap downs? Where's that awful morning action? It's gone. We're in a different environment. Now, in bull market advances, typical behavior is either a gap up with maybe a little bit of selling in the morning and then recovery to stay in that uptrend, or sometimes you get a little bit of a move to the downside in the morning, at the open. And again, mostly moves up or sideways action. We just haven't seen any big selling for quite a while. And I don't think we're going to see any big selling. When I talk about big selling, I'm talking about 10% correction or a bear market, cyclical bear market. I don't see anything like that out there for quite a while. Could we drop 5%? Sure. And that'll happen from time to time. But when it's going to start, that's anybody's guess. It could start any time given some of our short-term signals. All right, S&P 500, let's move on. There's your breakout again. Still have a slight negative divergence. And this is what can happen to negative divergences. They can be eliminated. They can just go away. A lot of folks, as soon as they see a negative divergence, they immediately want to go short. And I think that's a mistake, because if you've been in an uptrend for a while and you go back and you look, when you first make the breakout, the next breakout, you almost always have a negative divergence. Once the trend is established and you pull back for a little bit and then you make another breakout, that generally, you're already stretched, and that PPO or whatever momentum oscillator you use starts to roll over. And once it starts to roll over and you first make a breakout, it's going to take a little while for it to get going again. So sometimes, you get that breakout, you see a negative divergence, you immediately want to scream, sell, sell, sell. But you've got to let this run play to the upside. We may just keep going higher, and this negative divergence may be gone. We may see that PPO break to a new high. We're not that far from that. On the NASDAQ, we have a similar look, but we have a little bit further to go to get that PPO up to where we were just a month or so ago. Now we are stretched right now on the, I showed you on the S&P and on the NASDAQ 100, we're a little bit stretched above the 20-day moving average. So we need to be a little bit careful here. Any kind of a pullback we saw right around this time of the month in June, we had that pullback back near the 20-day. And if you go back and you look, the 19th to the 25th of calendar months is the most bearish time of the calendar month historically. Not every month, just historically. So you have tendencies. And if you go back and you look, there are a lot of downtrends that you'll see in this period of the month. Look at February, just as we went. That was a huge move down. Started almost perfectly, right on time. I think there were like 8 or 9 months of the last 12 where we've seen this 19th to the 25th create problems for the market. Today, it's the 19th. I don't know what's going to happen between now and the 25th. All I can tell you is that one signal, our historical signal, says you want to be careful this time of the month. All right. IWM breaking out again. I mean, that little sideways, consolidation, island cluster, whatever you want to call it. Well, it is no more. We broke out. We are heading for that 198, 199 level. And ultimately, in my opinion, we're breaking out. Could we have a pullback to the 20-day first? Sure. But in my opinion, if we're looking out another few months, couple months, we're going to see higher prices, in my opinion, on the IWM. Small caps are starting to move. Transports, there, I showed you earlier, there's another breakout. And here's a perfect example. There's a slight negative divergence on this breakout. We've been going up for a while. When we made this breakout right here a couple of weeks ago, if you had just stopped the chart right there, we would have had a slight negative divergence. But what happened? We kept going up. We put in a new high. Here, we're breaking out. We got a slight negative divergence. If transports keep going up for the next few days, that PPO is going to break out again to a new high. So be careful with negative divergences. Don't act too soon. All right, chart of the day. When we do these charts of the day, I always encourage everyone to go over to earningsbeats.com because we have a 3 times a week newsletter. So if you like a look at a chart, many times it's educational. I try to make it educational, try to give back to the community, try to teach folks some of the things that I've learned over the years. But if you want to subscribe to our EB Digest completely free, no credit card required, you can unsubscribe at any time. Monday, Wednesday, Friday, 8:30 a.m. That's when we try to get that out. All it takes is a name and email address. We'll get you started. So make sure you get that set up. If you want to try our 30-day trial to our paid service, that also is free, but it does require a credit card. Simply click on this button, start your no-cost trial, and then right down below, you'll see some of the services that you'll get. And then here's your subscription form. Very simple to fill out. We'll get you started. and you'll be able to attend our 10 o'clock live trading room this morning in just a bit. So make sure you check all of that out. So the chart of the day today, I wanted to talk about the banks. Now, the banks I showed you earlier starting to make that move to the upside. Look at the weekly chart. Now, the weekly chart will give you some, some reason for maybe a little pause, some concern. I think the bottom is in, just like in the pandemic, we had that straight move down, or even going back into 2016, that straight move down. A lot of times that carves out the bottom. We bounce off of it. Here we went down, we, did a little sideways moving, little upside, little sideways, but then eventually moved higher. I think this is going to be the latest of temporary bottoms, or I shouldn't say temporary, intermediate term bottoms. I think this is a pretty significant bottom. And I believe even if we do consolidate for a little bit, I think the next big move is going to be to the upside. Banks have been beaten down. I think the environment for banks will begin to improve when the Fed puts a halt to the Fed funds rate. Eventually, I think they're going to start to lower because they can, because inflation won't be a problem. So when they start to lower, the inverted yield curve will switch. And I think the market is already beginning to anticipate that with banks. All right, let's move on. I want to talk about our model ETF portfolio. I'm going to go back to our homepage here, because if you scroll down, you'll see under the historical performance, this is through yesterday's close. And our model ETF portfolio, we put ETFs in there. We do what I call a draft of ETFs once every 3 months. And so we do that for our model ETF portfolio on January 19th, April 19th, July 19th, and then on October 19th. Those are the 4 draft dates. And what we're doing is we're basically exiting whatever ETFs we had for the prior 90 days, and we announce how we're allocating our ETFs going for the next 90 days. Well, today ends the last quarter that we were in, and I want you to check out this quarterly performance right here. We were up 13.69% this quarter. The S&P 500 was up 9.64%. Our model ETF portfolio, which is pretty diversified, as ETFs will be, outperformed by 4 full percentage points over the S&P 500. Now, if you look at your, if you start projecting where you are in terms of, your investments and where you want to be in 10, 20, 30 years, whatever your horizon is and your goals, it's important. If you can beat the S&P 500 by 1 percentage point for the entire year, it will make a world of difference in your future, your financial future. Just by beating by 1% for a year, I can promise you that just about every portfolio manager out there, which most of them lose to the S&P 500, just about everyone out there would love to be able to tout that they average beating the S&P 500 by 1 percentage point per year. It would make a huge difference. They'd have so much money coming in, inflows. It would be crazy. To take a portfolio of ETFs and beat the S&P, and I'm not talking about these juiced ETFs. I'm talking about just regular ETFs. To take those and beat by 4 percentage points is outstanding. And we have crushed the S&P 500 for the last 18 months. Since the beginning of the cyclical bear market, we have been on fire relative to the S&P 500. We outperformed during the bear market. We're crushing it during the bull market. And I'm going to show you a little bit of how we do this. Our next draft, by the way, is not going to be today. Normally it would be. But what we're starting to notice in our portfolios is that we're starting off these quarters in not so great fashion, because it's the 19th to the 25th, right? And I showed you some of those months where the 19th to the 25th not performing well. So we're jumping in on the 19th. Probably isn't the smartest thing we've ever done. I admit that. So what we're going to do is we're going to wait on the draft, and we're going to select next Tuesday, the 25th. And that's going to be when the draft is. So from today's close through the 25th of next week, or through Tuesday of next week, we'll be in cash. If the market keeps going up, we'll have to make up some ground. If the market goes down, which happens, more often than not, then it'll give us a leg up. We'll actually be ahead of the S&P 500 by sitting in cash. So how do we do it? Well, I mean, part of it with the stock market, there's always a part that's luck. I mean, you've got to, I think you can get the luck on your side by doing a lot of research, doing, a lot of searching, a lot of, looking beneath the surface, trying to find themes. And that's one of the things that really helps us in putting these portfolios together. In other words, does it look like growth is going to outperform value? If so, that's going to obviously impact the way you pick your ETFs. Do you like the areas that are most heavily represented in the S&P 500, like technology? Because if you do, then you might want to overweight areas like that in order to try to outperform the S&P 500. The S&P, if it has 27% in technology, and you put together an ETF portfolio that has 20% in technology, if technology has a good quarter, that's going to make it more difficult for you to outperform. But if you have 35% in technology and technology outperforms, then you've got a better chance. Let me show you. I want to show you a spreadsheet that I share with our members, and this is something that you can download into your account. But let me pull this up for you. So this is last quarter's, what we call our ETF Analyzer. And so going into each quarterly draft, what I do is I run a scan at stock charts, looking for the top. I look for basically ETFs that have scooter scores, stock charts technical rank, scooter scores above 75. That's where I start. Because if the scooter score is above 75, then you're starting with some pretty good relative strength. These are going to be ETFs that are performing pretty well relative to the S&P 500. So looking at this, what I do is I take those ETFs and then I get rid of anything that comes up, international ETFs. I don't proclaim to be an expert in international stocks, and don't understand all the geopolitical issues and events that could take place. It's hard enough just focusing on US stocks. So when I talk about putting together an ETF portfolio, let's say, you're somebody that is interested in this, and you like 80% US, 20% international. Well, you just have to go somewhere else for the 20%. I mean, I think a lot of these ETFs are kind of global in nature. I mean, companies today, especially big companies, have global operations. So you're still getting that global flavor, even if you're going with an all US ETF. So just want to point that out. But I'm not going into specific international ETFs. So I get rid of them. I get rid of all the bond funds. I'm looking at the stock market. If you want to invest in bonds, think about doing that elsewhere. I get rid of all the leveraged ETFs or juiced ETFs. So the 2 times, 3 times, all the inverse ETFs, all that stuff. I don't look at any of that. I look at just a stripped down, version of ETFs. And what I do is I list them for our members in an Excel spreadsheet, ticker, the name of the ETF, and then the top 10 holdings. How much do they represent? For instance, in this ACWI, the top 10 holdings represent 15.6% of the entire ETF. That tells you that is a pretty diversified ETF. When you start getting down, when your top 10 holdings only total 15%, that's pretty diversified. When you have, like in this aerospace and defense index fund, the top 10 holdings represent 76%. That's a little different picture. Now your top 10 holdings, you really better like those top 10 holdings, because that essentially is just about the entire ETF. So that's a much more concentrated ETF, and it's in a specific area, aerospace and defense. So I mean, sometimes folks just say, well, this ITA, this is a really good ETF. I'm just going to put 40% in it. Well, they think ETFs by nature are diversified. Some are, some aren't. You put 40% in here, you got a lot of your money invested in a small number of aerospace and defense stocks. So one of the things we always talk about at Earnings Beats is know what you own. When it comes to ETFs, know what you own. And this ETF analyzer will tell you exactly what you own. So any of these ETFs, you can go to the next tab over here, this top 10 holdings. And let me just show you the ACWI and the ITA. So there's your ACWI. Here are your top 10 holdings. They total 15.6%. They got a healthy amount of Apple and Microsoft in it. But after that, it's very, very diluted. So very diversified one. Let's take a look at that ITA. Now, here's the one that's got 75%. I sure hope you like Raytheon, because that's almost 21%. Boeing is 17%. I mean, if you like those two companies and you want to get aggressive, ITA is the way to go. I guess 37, almost 38% of the ETF is in those two companies. Then you got Lockheed Martin, another 8%. So you're getting close to half the ETF with 3 stocks. Throw General Dynamics in and you're above 50%. So know what you own. All right. And the cool part about this ETF analyzer is that when you come across here, you'll see that I've broken down every ETF across the 11 sectors. So you can see how much of the ETF is invested in the various sectors, right? So as you go through this, you can look at the top 10 holdings, maybe see some stocks that you like. You might want to go with the highly concentrated, or you might want the highly diversified. Completely up to you. But again, this is how you put together a portfolio and know what you own. Now, up here at the top, what you'll see is the S&P 500, and this is going into last quarter. The S&P was represented 26% by technology. That was the largest area of concentration. Then you had over here 14% in healthcare, 13% in financials, 10% in discretionary, and so forth across the board. And that all totaled up to 100%. Now up here, I've got your results. And what you do here is you come down in this allocation percentage and you start putting in your percentages. So you could say, okay, I'm going to put 50% in this ITA, and I'm going to put 50% in the ACWI, and let's just see what happens. Well, you've got 10% in technology. You got 55% in industrials. You are very overweighted in industrials. If industrials don't perform well, you're in big trouble. So, or the other thing you could do is you could say, okay, I'm going to do 40% here. And you might think that you already, did 100%. You've only done 90, and it shows up right here, error. You got to put 10% somewhere else. So let's go down to this robotics and put 10% in. Now this says no error, and it equals 100%. So it's got a built-in audit feature to make sure that you're putting in 100%. And then it's spitting out how you came across and how your portfolio is allocated amongst the 11 sectors. So here's our actual selection last quarter, where we picked 5% software, 15% for this JP Morgan US quality factor. You can see looking across here, this is a pretty well diversified. So this was kind of one of the staples. Usually 15, 20% is kind of a staple ETF. This Morningstar wide moat from Van Eck, 20% in that. You can kind of see, again, very, very well diversified. But then I also went 20% in the QQQ, which is 50% technology. So obviously I was placing a little bit more of a bet on technology, and technology's had a great quarter, which helped our ETF portfolio. Going down here, you can see I always, in addition to the 75 score on the scooter, that was one filter in putting these ETFs on here. The other thing I always do is I list all 11 of these sector ETFs, no matter what their scooter score is. Excuse me. And the reason I do that is because at the end, if most of the areas that have been beating the market and are showing relative strength, if they're all concentrated in like technology, consumer discretionary, it's going to be hard for me to get somewhat of a balance in my model ETF portfolio. So this always allows me the opportunity, if for some reason, like in healthcare, I wanted to get a little bit more healthcare, and with the ETFs I picked, I didn't have as much as I wanted. So I went in and directly put 10% into the healthcare ETF. And I think it's a great way to do this. And so I went through and, I want to talk to you about this right here in the middle. So before I actually put the allocations in here, I went up and I said, looking at all the intermarket relationships, looking at everything, all the themes that I thought maybe would work out in this past quarter, I said, okay, where do I want my percentages to be in order to try to outperform the S&P 500? I thought it was going to be a great quarter, so I wanted to outperform in the areas that I thought would lead. I wanted to have more representation in those areas. So technology, which is 26% of the S&P, at least it was going into last quarter, I just put an initial target and said it'd be nice if I can put this portfolio together and have 35% in technology, 15% in discretionary instead of 10, 15% in communication services instead of 8. And then I would underweight everything else except for healthcare. I wanted roughly to be about equal weighted in healthcare. And so that was kind of my goal. And then after I put in all these ETFs, I can see how my actual numbers come in relative to what I wanted. And you can see I came in pretty close on my technology. I was a little bit below what I wanted on these two, but still I overweighted both of them. So I was okay. These were both underweighted like I wanted, industrials and financials, and they underperformed. We're just now starting to see the financials come to life. So that percentage is probably going to change for next quarter. I think financials will do better next quarter. Healthcare was right about, close, staples close. Real estate, I had almost nothing, which was good because real estate was horrible. Utilities, energy, they're all the defensive groups, and even energy and materials, wasn't really liking those. So I underweighted. And so again, this is how I know what I own. This is when we put these portfolios together. If they don't do well, I can promise you at the end of the quarter, I can tell you why. Most folks get into ETFs. They don't know what they're putting together. They don't know what they own in terms of the sectors. They don't know why they're outperforming or underperforming. They just get upset. Why is the S&P up 10% and I'm only up 6% with my ETFs? Well, it's because of the way those ETFs are invested. So anyway, that was it. I just wanted to show you how we do this. Next Tuesday, we're going to actually have a webinar where I'm going to have this out and I'm going to show you exactly what percentages we're putting in where and why we're coming up with these percentages. So if you invest in ETFs, you want to be there. I've never seen anyone else look at ETFs the way we do, and I think this is the best way to look at ETFs. So hopefully, you can appreciate that and want to join us. It is a members only event though next week. So you do need to be that. If you start a 30-day trial, come join me in the trading room in 20 minutes, and then you'll be part of this next Tuesday. It's a no-brainer. You definitely should be Earnings Beats member. We'd love to have you. All right, let me just show you what the market's doing, because we do have market open now. So last thing before we wrap up. And again, if you go over here to our home before we look at that, that's where you can start your no-cost trial. And just one more reminder on the EB Digest. That's where you can get in there and get your free subscription started to that. All of it at earningsbeats.com. All right, so what's the market doing? Well, let's just take a look here. Go into the dashboard. Got another pretty decent day brewing. Dow Jones up 0.43%, S&P 4.2%, NASDAQ up about 0.3%, small caps in that same area. The VIX hanging tough. It's not really going down, hasn't hit its recent lows, even though the market keeps going up. So that still makes me a little nervous about the rally, but until we get a reversing candle, until we get something like that, it's hard to bet against a secular bull market advance. And that's what we have in play here. S&P 500, you can kind of see Northern Trust, NTRS. That is a Financial stock didn't look very good into its earnings, but it is rallying this morning, big time, up 8%. Nothing really exciting here on the list. Down OMC, pull that chart up. It's back down closer to the support area. But overall, it looks like a pretty good day for the market. We do have KLA, which is a semiconductor, down about 2%. Applied Materials, another semiconductor. So might be seeing a little bit of rough action in semiconductors just based on that quick little look. But anyway, that's it. So hopefully 20 minutes from now, we'll start our live trading room. I hope to see you then. Happy trading, everybody.